The headline is arresting. A flagship investment fund, renowned for its forward-looking bets on disruptive technology, has executed a significant rebalance. It has taken profits from a quintessential tech titan, Tesla, and actively deployed capital into the cryptocurrency ecosystem. This is not a tabloid rumor or a fringe maneuver. It is a documented material transaction by ARK Invest, an institution with a meticulously tracked portfolio and a vocal analytical leader. To dismiss this as simple profit-taking or a minor portfolio tweak is to profoundly misunderstand its symbolism and substance. This move represents a definitive strategic pivot, a clear signal that sophisticated capital now views digital assets not as a peripheral gamble, but as a core structural component of the next generation investment landscape. Let's deconstruct the anatomy of this pivot, for its composition reveals its intent. This was not a mere purchase of Bitcoin or Ethereum spot tokens on a retail exchange. The allocation was multifaceted and deliberate, targeting the very infrastructure of the digital asset economy. It included public equity exposure, buying shares of publicly traded companies whose business models are intrinsically tied to crypto, such as Coinbase. This is a play on the ecosystem's growth through traditional securities. Infrastructure and service providers, allocating to firms like Bitfarms, mining, and Circle stablecoin issuance. This bets on the essential picks and shovels services that enable the crypto economy to function. Direct protocol exposure, acquiring stakes in the native assets of protocols themselves, namely Ether, ETH, and Solana, SOL. This represents a pure, non-diluted claim on the success of those decentralized networks. This tripartite strategy is critical. It is not a binary in or out bet on price appreciation. Instead, it is a layered wager on the entire value chain. The public companies that provide access and services, the private firms that build critical infrastructure, and the foundational protocols that constitute the new Internet of Value. By deploying capital across these layers, the fund is insulating itself from the success of any single company or token, and betting on the thematic rise of the entire sector. The combined position, reportedly reaching a low double-digit percentage of the fund, is the exclamation point on this sentence. Oh, this is not a 1-2% satellite holding for optionality. This is an all-weather strategic allocation designed to materially impact overall fund performance. The profound implication of this move extends far beyond one fund's quarterly filing. It acts as a bellwether and a potential accelerant for a broader institutional mindset shift. For years, the institutional barrier to crypto was a triad of concerns: regulatory uncertainty, custody challenges, and a perceived lack of intrinsic value or storage. This pivot suggests a key player has adjudicated these risks to be manageable or outweighed by the opportunity. When a firm like ARK, with its rigorous research process, its focus on disruptive innovation, and its fiduciary duty, makes such an allocation, it sends a powerful signal to the rest of the institutional world. The foundational due diligence is done. The asset class is mature enough for strategic deployment. This begins to dismantle the legitimacy barrier. Other fund managers, family offices, and endowments watching this move are presented with a validated blueprint. They are no longer pioneering uncharted, reputationally risky territory alone. A credible peer has provided a publicly scrutinizable case study in how to construct a crypto allocation. This can catalyze a domino effect where the fear of being first is replaced by the fear of missing out, FOMO, as others follow suit. Furthermore, this pivot must be understood within the context of the fund's overarching narrative. ARK's foundational thesis is centered on identifying and investing in disruptive innovation that will define the next economic paradigm: genomic sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. By elevating its crypto allocation to this strategic level, the firm is formally codifying blockchain and digital assets into that pantheon of world-changing technologies. It is declaring that the future of finance, governance, and digital ownership will be built on these protocols, and thus a forward-looking portfolio must have direct material exposure to their success. In a world facing monetary debasement, geopolitical fragmentation, and the digitization of every asset, crypto represents a unique form of financial and technological optionality. It is optionality against inflation via hard-cap digital scarcity, Bitcoin. It is optionality against traditional inefficient financial rails via programmable settlement layers, Ethereum, Solana. It is optionality against closed platform data monopolies via user-owned networks. By allocating to this sector, the fund is not merely buying an asset. It is purchasing a strategic option on a different financial future. The reallocation from Tesla, a magnificent disruptor of the past era in automotive and energy, to crypto, a foundational architecture for the next era, is therefore a logical, if bold, evolution of a disruption-focused mandate. In conclusion, the ARK Invest portfolio shift is a multifaceted signal. It is a tactical move into a diversifying asset with high growth potential. It is a strategic bet on the infrastructure of a new financial system. And it is a symbolic ratification of crypto's arrival as a legitimate institutional-grade asset class. This pivot provides a template, reduces perceived risk for followers, and underscores that the most forward-thinking capital is no longer just watching the digital asset revolution. It is actively funding its construction. The era of institutional curiosity is transitioning into the era of institutional commitment. The most common misconception among crypto participants is that the market operates as a sovereign entity driven purely by its own internal narratives of halvings, protocol upgrades, and meme coin mania. While these factors create texture and volatility, they are secondary actors on a stage built and illuminated by a much larger, more powerful force: global macroeconomic policy. To understand crypto's price action in the coming months is to become, first and foremost, a student of central bank balance sheets, inflation reports, and employment data. Crypto is not the driver in this relationship. It is a high beta, highly sensitive passenger in the vehicle of global liquidity, and the Federal Reserve and its global counterparts hold the steering wheel and control the fuel injection. The fundamental equation is one of liquidity and opportunity cost. Capital is nomadic. It flows relentlessly toward environments that offer the highest perceived return for a given level of risk. For the past 2 years, the dominant environment has been one of financial repression. High inflation met with rapidly rising interest rates. In this world, the risk-free rate offered by government bonds, e.g. U.S. Treasuries, became compelling, soaring from near zero to over 5%. This presented a legitimate, safe alternative for capital. Why risk capital in volatile tech stocks or speculative crypto assets when you can park it in short-term treasuries and earn a guaranteed, handsome yield? This dynamic sucked liquidity out of risk assets, acting as a powerful gravitational pull that suppressed their prices. Crypto, as the ultimate risk asset, felt this pull most acutely. The entire thesis for a sustained crypto bull market hinges on the inversion of this dynamic. The catalyst is not a new NFT standard or a partnership announcement. It is a change in the macro weather. This is where the scripts focus on the Consumer Price Index, CPI, non-farm payrolls, and the Federal Reserve's dot plot becomes paramount. The market is obsessively watching for a specific sequence of data: sustained cooling of inflation, confirmation that CPI is trending convincingly back toward the Fed's 2% target, proving their policy is working. A softening but not breaking labor market, evidence that the job market is cooling from its red-hot state, indicated by rising unemployment claims, slower wage growth, or a decline in job openings, without collapsing into a recessionary spike. This gives the Fed the cover it needs to pivot. When this data cocktail materializes, it triggers a powerful chain reaction. The market's probability machine, the CME Fed Watch tool, shifts and the odds of interest rate cuts surge. Rate cuts are the rocket fuel. They directly lower the risk-free rate of return. Suddenly, that 5% yield on a treasury bill evaporates, perhaps falling to 3–4%. The guaranteed return becomes less attractive. Capital, in its endless search for yield, must now look elsewhere. It redeploys out of safe bonds and back into the risk curve, first into high-quality corporate debt and blue-chip stocks, then into growth tech stocks, and finally into the highest octane, highest upside assets on the planet, cryptocurrencies. This is the liquidity slingshot effect. Crypto doesn't rally because of its own news. It rallies because a tsunami of newly emboldened capital, freed from the shackles of high yields, floods into it. However, this script introduces a critical and under-discussed wildcard, the Bank of Japan, BOJ. For decades, Japan has been the world's great provider of cheap money through its policy of zero to negative interest rates and yield curve control. Japanese investors and institutions seeking any yield became massive buyers of global assets, including U.S. treasuries. This yen carry trade has been a pillar of global liquidity. If the BOJ finally hikes rates, ending the world's last experiment with negative rates, it would be a seismic event. It would trigger a massive, rapid repatriation of capital. This would cause violent, correlated sell-offs across global bond and equity markets as assets are liquidated to bring money home. In this scenario, crypto would not be spared. It would be caught in the initial risk-off hurricane. This is the potential shockwave and short-term dip mentioned. The sophisticated institutional move is to position ahead of this volatility, to have dry powder ready to buy the very dip that a macro event on the other side of the world creates. Therefore, the current phase is not about picking the next altcoin. It is about navigating the macro pivot. It is a two-stage process. Stage 1, the setup, monitoring U.S. data for the all-clear signal on inflation, which unlocks the rate cut narrative and begins the liquidity shift. This is a gradual anticipatory phase. Stage 2, the trigger and potential shock, navigating the actual commencement of the Fed's cutting cycle while simultaneously bracing for the potential exogenous shock from Japan, which could create a final painful shakeout before the true bull run begins. This is why the analyst in the script is looking at charts and asking, how deep could a sell-off go? 20%? 30%? They are not looking at crypto charts in a vacuum. They are trying to model the beta coefficient of crypto to a potential global liquidity shock. They are assessing how violently crypto might react if the BOJ acts or if U.S. data turns hotter than expected, delaying the Fed's pivot. In essence, crypto's near-term destiny is being written in the meeting rooms of the Mariner S. Eccles Federal Reserve Board building in Washington, D.C. and the Bank of Japan headquarters in Tokyo, not in a Discord channel or at a developer conference. The savvy investor understands this. They are not just following crypto Twitter. They are glued to Bloomberg terminal screens, watching the yield on the 10-year Treasury, the DXY US dollar index, and Fed speeches. They know that when Jay Powell or Kazuo Yuta speaks, the crypto market will listen and react. The alpha in this market will not come from knowing a secret project launch date, but from correctly anticipating the next move of the world's most powerful financial institutions. The puppet masters of traditional finance are pulling the strings. Crypto's volatile dance is the result. The coming bull run will not be a crypto story. It will be a macro liquidity story that crypto benefits from most dramatically. For over a decade, the predominant narrative fueling cryptocurrency's rise has been one of philosophical revolution and speculative potential. It was the story of Bitcoin as digital gold, a stateless, censorship-resistant store of value in a world of printing presses. It was the promise of Ethereum as a world computer, a platform for decentralized applications that would topple corporate intermediaries. These were powerful, foundational ideas that attracted pioneers, ideologues, and speculators. However, for the vast machinery of global finance to engage, narrative alone is insufficient. It requires something tangible, reliable, and mundane. Infrastructure. We are now witnessing the decisive, irreversible pivot from a market driven by stories to one powered by plumbing, from speculative betting on an idea to strategic investment in a new financial operating system. This is the quiet, profound revolution happening beneath the price charts. The most potent symbol of this shift is JP Morgan's tokenized collateral network and its tokenized money market fund. This is not a press release about exploring blockchain. This is the world's most systemically important bank, the custodian of traditional finance, moving real, regulated financial instruments, treasury bonds, onto a programmable, blockchain-based ledger. The distinction is critical. They are not using a speculative public crypto asset like Bitcoin. They are using a permissioned blockchain to create a digitized, more efficient representation of the oldest, most trusted asset. This achieves two monumental things. It validates the underlying technology, distributed ledgers, smart contracts, while largely sidestepping the regulatory uncertainty of the native asset. It proves the technology's utility for settlement, transparency, and speed within the existing trillion-dollar world of interbank transactions. This is the ultimate Trojan horse for blockchain adoption within traditional finance, TradFi. This move by J.P. Morgan is not an endpoint. It is the ignition of a domino effect of institutional utility. Once one major bank demonstrates a working cost-saving, risk-reducing application of tokenization, the competitive pressure on every other bank, asset manager, and custodian becomes immense. We will see a rapid sequence of similar announcements: tokenized private equity funds, tokenized real estate, tokenized carbon credits, and intraday repo markets operating 24/7 on a shared ledger. Each new use case does not merely adopt crypto. It builds out the rails upon which a new hybrid financial system will run. This creates a self-reinforcing cycle. More institutional use cases demand more robust, compliant infrastructure, regulated custody, audit trails, insurance, which in turn makes the system more attractive for the next wave of institutional entrants. This is the boring, billion-dollar back-end work that creates a durable foundation, a foundation that can later support more consumer-facing public blockchain applications. This infrastructure build-out directly redefines the investment thesis for assets like Ethereum. The narrative is evolving from ETH is gas for apps to ETH is the global settlement layer for institutional value. The focus shifts from the number of decentralized exchanges, DEX, on Ethereum to the volume of real-world assets, raw, being tokenized onto its ecosystem. Projects bringing U.S. treasuries, municipal bonds, and corporate debt on-chain are not merely creating new DeFi yield products. They are performing the essential, unglamorous work of bridging the old economy to the new. They are creating the on-ramps through which traditional liquidity can seamlessly enter the crypto ecosystem to earn yield or facilitate transactions. An Ethereum that settles billions in tokenized T-bills daily is an Ethereum with a fundamentally different, more resilient, and institutional-grade value proposition than one known solely for NFT profile pictures. This infrastructure phase also creates a new class of picks and shovels, investment opportunities that are far less volatile and more analogous to traditional equity investment. This is precisely what the fund's allocation highlights. Stablecoin issuers like Circle and crypto-native financial service providers like Coinbase. They are financial utilities. Circle's USDC is becoming the digital dollar settlement layer for this new system. Coinbase provides the critical regulated interface between fiat banking and crypto networks, along with institutional-grade custody. Investing in these companies is a bet on the volume of economic activity flowing through the crypto rails, not on the moonshot price of a particular token. It is a bet on transaction fees, custody fees, and interest income. Revenue streams any traditional analyst can model. Finally, this shift from narrative to infrastructure changes the very nature of risk. The early narrative phase was plagued by existential risks. Would governments ban it? Would the technology fail? Would it ever be useful? The infrastructure phase confronts execution and integration risks. Can the scaling solutions handle the volume? Can the regulatory frameworks be navigated? Can the legacy systems integrate with the new rail? These are complex but solvable challenges, the kind that large corporations and governments grapple with every day. This transition from existential to executional risk is what finally allows pension funds, insurers, and sovereign wealth funds to begin their formal due diligence processes. In conclusion, the true measure of crypto's maturation is no longer its price in US dollars, but the dollar value of real-world economic activity it settles and facilitates. the launch of a tokenized money market fund by JP Morgan is a more significant long-term bullish indicator than any single celebrity endorsement or meme coin pump. It signifies that the world's most powerful financial institutions are no longer asking if the technology will be used, but how and by whom first. They are moving beyond the speculative narrative to build the indispensable infrastructure, the pipes, the switches, the regulatory frameworks. They are not merely adopting crypto. They are industrializing blockchain. In doing so, they are constructing the very operating system for the next era of finance. And in this new system, crypto's native assets transition from being the entire story to becoming the vital, high-performance components within a much larger, more stable, and infinitely more powerful machine. To understand the powerful gathering force behind mainstream crypto adoption, one must look beyond the Bloomberg terminals and trading floors and into the kitchen tables and bank statements of the average citizen. The technical analysis of chart patterns and the intricacies of monetary policy are secondary to a far more visceral, pervasive human reality, a deep and growing sense of economic precariousness. The fundamental driver for the next wave of crypto adoption is not greed for 100x returns, but a profound anxiety about the stability and fairness of the traditional financial system. It is a shift from speculative number go up to a pragmatic search for agency, security, and an alternative. This brewing discontent is, as the script notes, the coming political battleground. Affordability will be the central theme of elections. When political solutions are perceived as slow, ineffective, or captured by special interests, individuals will seek technological solutions. Crypto is positioned as exactly that, a parallel, opt-in system that operates outside the legacy political framework. This is why adoption becomes a socio-economic trend, not merely a financial one. It is a grassroots response to systemic frustration. This dynamic creates a powerful long-term demand driver that is decoupled from short-term price action. People may buy Bitcoin when it's rising, but they hold it when they believe it represents a fundamental safeguard. This transforms crypto from a speculative asset class into what some call a belief asset or a socio-economic movement with a balance sheet. The holder is not just an investor. They are a participant in an alternative vision of finance. This psychological shift creates a far more resilient holder base, one that is likely to weather volatility because the motivation is rooted in a deeper need for security and autonomy, not just profit-taking. In essence, the macro data points the script analyses, CPI, unemployment, are not just numbers that move markets. They are indicators of social stress. They measure the pressure building within the system. Cryptocurrency, for all its volatility and complexity, offers a pressure release valve. It offers a narrative of hope and a tool for personal agency in an economy that feels increasingly hostile and unpredictable. The next bull market will not be fueled solely by institutional capital allocation, Keynote 1, or macro liquidity, Keynote 2. It will be supercharged by the conversion of millions of people's economic anxiety into a search for alternatives and their discovery of a digital decentralized system that promises, rightly or wrongly, a way out. The why is no longer about getting a Lamborghini. It's about ensuring you can keep the car you already have. It's a less glamorous, but infinitely more powerful and durable foundation for mass adoption. We stand at the precipice of a new investment paradigm, one defined not by the rise of a single technology, but by that powerful, synergistic convergence of three monumental forces: artificial intelligence, AI, cryptocurrency, blockchain, and regulatory clarity. Individually, each represents a transformative trend capable of generating trillions in value. Together, they form a self-reinforcing trifecta, a flywheel that promises to define the next epoch of technological and financial development. This convergence is the master narrative that supersedes all other sector-specific stories, and understanding its interplay is key to positioning for the coming decade. First, consider the AI-crypto symbiosis. On the surface, they are distinct. AI is about centralized data processing and intelligence generation. Crypto is about decentralized trust and value transfer, yet their futures are inextricably linked through complementary needs. AI, in its relentless growth, requires three things that crypto is uniquely positioned to provide: verifiable data provenance and integrity. AI models are only as good as their training data. Blockchain provides an immutable ledger to track data lineage, proving its origin and ensuring it hasn't been tampered with. This creates a market for verified data, potentially tokenized and sold by individuals, compensating them for their contribution to the AI ecosystem. Decentralized compute and storage. The insatiable demand for GPU power and data storage for AI training and inference can be met by decentralized networks like Render, Akash, or Fieldcoin. These crypto protocols can create more efficient global markets for computing resources, reducing dependency on centralized cloud oligopolies and lowering costs. Autonomous economic agents and value settlement. As AI evolves into autonomous agents that perform tasks, negotiate, and create value, they will need a native financial system. Blockchain provides the perfect settlement layer. A global, permissionless, 24/7 payment rail where AI agents can hold assets, pay for services, and transact with each other and humans without a bank account. Conversely, crypto needs AI. AI can be applied to smart contract auditing to find vulnerabilities to optimize decentralized autonomous organization, DAO governance, to provide sophisticated on-chain trading and analytics, and to enhance user security. This creates a powerful narrative for capital. The two most disruptive tech themes of our time are not competitors for investor attention, but essential co-pilots. Investing in one is a bet on the infrastructure needed by the other. The second leg of this convergence is the impending wave of regulatory clarity symbolized by legislative efforts like the Clarity Act. For years, regulatory ambiguity has been the single largest brake on institutional capital. Major asset managers, banks, and corporations have watched from the sidelines, their compliance and legal departments unwilling to greenlight significant exposure to an asset class that could be deemed a security, a commodity, or something else by a changing regulatory whim. A clear, coherent federal framework, even a restrictive one, is preferable to the current state of uncertainty. It defines the rules of the game. Once the rules are known, the world's largest pools of capital can build operational procedures, risk models, and investment theses. This is not about making crypto legitimate in the eyes of speculators. It's about unlocking the trillions of dollars in hesitant institutional capital currently held in a bank. Clear regulation acts as the final permission slip for pension funds, endowments, and sovereign wealth funds to begin making strategic, long-term allocations. This is where the convergence becomes a flywheel. AI growth increases demand for decentralized compute and data markets, benefiting crypto infrastructure. Crypto's maturation and institutional adoption, aided by regulatory clarity, creates a robust, liquid, and compliant digital asset ecosystem. This mature digital ecosystem becomes the ideal programmable economic layer for AI agents and applications, accelerating AI's own development and integration into the economy. The resulting economic activity and innovation force regulators to further refine and adapt frameworks, leading to more sophisticated and enabling regulation. This convergence also reshapes valuation models. As the script suggests, analysts are beginning to ask why a predictable infrastructure-level tech company like NVIDIA should trade at a lower earnings multiple than predictable infrastructure-level retailers like Costco. The ultimate opportunity lies at the intersections, in the companies and protocols that enable AI to operate on decentralized networks that bring real-world assets and institutional capital on-chain through compliant pathways.